All right, everyone. We are going to review some of the major changes made in the Secure Act 2.0 that passed end of 2022. It is the first week of 2023. So, as we kind of go further into this year, we'll see some of the ramifications of the Secure Act. There were a very, very large number of changes that were made. I believe I heard from a retirement standpoint, it was around 100, if not a little bit over, of changes made in the Secure Act 2.0. We are going to hit the main ones we think apply most to most people, but by no means is this a comprehensive list of all the changes made in the Secure Act. And we're not going to jump into a lot of detail on these changes. We're going to really just do the highlights for how they might affect someone's plan and what we might see some changes going forward into these. But we're going to link a very detailed article in the notes from the video so you can go review it for yourself, dig a little bit deeper. And if you have any questions on how this might affect your plan, feel free to reach out to us and we can go through what of these changes will affect you and how it'll affect you. So, first really big one was required minimum distribution ages changed. So, really, when you're looking at required minimum distributions, if you were born 1950 or earlier, your required minimum distribution is 72. If you were born from 1951 to 1959, your required minimum distribution age now is 73. In 1960 or later, your required minimum distribution age was pushed to 75. So that is effective now, year 2023. Those new required minimum distribution ages go into effect. So here's just kind of a quick run through of what you can kind of look for. So if you were planning to start requirement distributions, do you still need to? In general, if you turn 72 in 2022, you need to take your first required minimum distribution in 2023. Although it is worth noting that in 2023, it's kind of a weird year where you have some circumstances where you might actually not need to start it. It kind of created a little bit of a gap year. You can feel free to read this kind of example and again dig into it a little bit early or a little bit deeper in the article attached. But again, basic thing is just required minimum distribution ages got pushed back for pretty much everyone. Now, as far as eliminating required minimum distributions for Roth plans, so when you look at required minimum distributions, they have traditionally been required for 401k pre-tax IRA, and then Roth 401ks. Now, in reality and in practice, since they were required for Roth 401ks, in almost 100% of cases, you would roll that Roth 401k into a Roth IRA, at which point you would not be required to have a required minimum distribution. So, what this change did was essentially it just said, all right, well, if you're in a Roth 401k and you leave it in the 401k or you leave it in the 403b or you leave it in the 457, you are not subject to required minimum distributions. Again, this is something that in practice you didn't really run into it because it was easily avoidable. They've just kind of changed that, and that is effective 2024. And one thing to note, a lot of the changes you'll see in this plan either go into effect 2023, 2024, or 2025. So it's kind of going to vary on which year it goes into effect. Next one, the creation of simple IRAs. Simple Roth IRAs and SEP Roth IRAs. So traditionally, you were able to do simple IRAs and SEP IRAs, which were both pre-tax accounts. As of 2023, you were able to create simple Roth IRAs and SEP Roth IRAs, which you were not able to do prior. Now, you might be legally able to now, but what you're probably going to find if you are a small business owner and you want to open one of these up, it's going to take a lot of custodians or 401k administrative firms a little while to get these set up. And I said 401k administrative firms, I meant just like custodial firms or administrative plans to get these set up. So it might be something that, yes, it is technically doable, but it might be a little bit, maybe a few months before you see applications start to pop up on like a Fidelity or any sort of kind of custodian to actually be able to open one of these types of plans. So as far as high wage earners, so they have pushed catch-up contributions for high wage earners to be forced into Roth contributions. So prior to this change, if you were a high income earner, and high income earner is $145,000, according to Secure Act 2.0, and you had a catch up contribution, so you were able to make additional contributions to a 401k plan after age 50, you could make those contributions into a pre tax 401k. Now, however, if your prior year's wages exceeded 145, so 145,000, that excess contribution, that catch-up contribution, in a 401k, 403b, or 457 plan will be required to go into a Roth plan. So not the initial normal contribution, just the catch-up contribution will be pushed into Roth plans. What that ultimately does is it forces you to pay taxes on those funds at that arguably probably higher tax rate while you're still working. And it forces that tax to be paid current year, which gives a little bit more revenue for this actual bill and a lot of the changes they made in this bill current year. But that goes into effect in 2024. So kind of to continue on that, it has some leeway for self-employed individuals and partners of like S corps, because it does technically say wages, which would be assumed W-2 wages. So there is some possibility where you might not have to do that with certain types of employment, as far as like self-employed individuals. There also is a stipulation where it's preceding calendar year from an employer sponsoring plan, which means that if you were to technically switch jobs halfway through the year and still make 145,000 or over, that it wouldn't fit the calendar year prior for a single employer sponsoring plan. So you might be able to kind of overlook that forced Roth contribution and still make the pre-tax contribution. That gets fairly in the weeds fairly quickly. I did at least want to notate it. There is some workaround if you are an individual switching jobs, or you are a self-employed or a partner of a firm, that there is some wiggle room within that. But generally, what it's trying to do is just say if you are a high income earner, your catch-up contribution is going to be pushed to Roth. As far as 529 to Roth IRA transfers, this is probably one of the biggest ones and one of the ones that was really talked about a lot, because a lot of the questions we typically get and you hear is, well, why should I use a 529 plan? What if my kid gets scholarships? What if they don't go to college? What if I have some left over? This essentially allows you to take that 529 plan and convert it to a Roth IRA after 15 years. And there are a lot of stipulations with what's allowable and how it's allowable. So you can see here that like it has to be a funded Roth IRA or 529 plan, has to be in maintenance for at least 15 years. The contributions have to be within the last 5 years. There's the annual limit that applies to regular IRA and Roth IRA contributions on a yearly basis, and there's a lifetime cap of 35,000. So you have to make sure you meet all of those, but it does do a great thing of just allowing essentially a parent to convert a 529 balances left over to an IRA, a Roth IRA in the beneficiary's name. If you do have excess funds in the 529 account, which is really nice. Again, you can see more detail in the article linked to this. Now, new options for surviving spouses as far as inheriting IRA accounts. So previously, if you were a surviving spouse, you had a few options available to you. You could roll the decedent's IRA into your own IRA and treat it as your own IRA. You could elect to treat the decedent's IRA as your own and remain the beneficiary of the decedent's IRA, but with special treatment. Now you have a third option, which is being able to treat it as the decedent's actual IRA. So that would be essentially keeping it as their IRA, but taking required minimum distributions off it as them. What that essentially allows is, like, if you have a much younger spouse that passes and has more favorable required minimum distribution terms, that might make more sense to leave the IRA as the deceased spouse and have it treated as theirs rather than rolling it into your own or rolling it into like an inherited IRA. Now, as far as IRA catch-up contributions, they will now be indexed with inflation. So one thing that's kind of happened over time is you've seen over the last few years, like Roth IRA and IRA contribution limits have increased. So like they're 5,000, they might be 5,500 or 6,000 or 6,500, but the actual catch-up contribution, which is the amount that you can put in over the contribution limit for people older than 50, is stated $1,000. That is now going to inflate up in $100 increments starting in 2024. So, for example, if you could put in $6,500 now is a normal IRA contribution for an annual amount. If you're over 50, you can put in $7,500, that extra $1,000. But as of 2024, that'll start to inflate up. So it might be you could put in another $1,100, $1,200, but that'll start to bump up with inflation as well, which is great for people trying to play catch up. When it comes to retirement savings, it just gives them a little bit of extra wiggle room to put more into their retirement accounts. Now, increased contributions for certain ages. So what this does is essentially allows increased employer retirement plan catch-up contribution limits for certain age groups or certain ages. So more specifically, if you are ages 60, 61, 62, or 63, you have the ability to do a catch-up contribution the greater of $10,000 or 150% of the regular catch-up contribution amount indexed for inflation. Again, gets into the weeds pretty quickly as to which one you can do. It starts in 2024. Please check out the linked article. It goes into more detail on that. And please reach out to us at 2024. We will work with you and make sure that you're taking advantage of the most you can put into your retirement accounts to really take advantage of that increased catch-up contribution. Again, this is targeting essentially someone that's trying to backload their retirement savings and needs to put as much away as possible. It gives them this option. Now, this is an interesting one. It's the creation of a linked emergency savings account. So this would be a standalone individual accounts is not what this is talking about, but rather this emergency savings account. Even though it sounds like it's standalone, it's really not. It's linked to an employer plan, such as like a 401k or a 403b. So essentially, you would be able to push funds into that emergency savings account. It's kind of designed for someone that is trying to build a emergency savings balance but doesn't necessarily have a lot of wiggle room within their own like monthly budget, and they want to try and use like employer matches or something along those lines to fund an emergency savings account. There are several limitations. There's contribution limits, there's income limitations on it. It's available. Again, check out the article. If this is something that you think would be beneficial, please reach out to us and we can kind of walk you through a little bit more of the details. But this is something that was added that is fairly new that we want to at least talk about and mention. Reduction of missing your RMD. So prior to this bill, if you did not take a required minimum distribution for 1 year, you had a 50% penalty on what that distribution would have been. That now falls to 25%. And then if you correct it within a certain window, which Window is essentially defined as the date that the penalty is imposed. So generally January 1st of the year following the year of the missed RMD, which again can get kind of confusing very quickly. That penalty drops to 10%. So a couple different windows you look at. So it ends earliest following this, like when the notice of deficiency is mailed to the taxpayer, when the tax is assessed by the IRS, the last day of the second tax year after the tax is imposed. You start to see that window end, but it does allow you to, one, if you miss it, not have as big of a penalty. And then if you correct it, have an even smaller penalty. This was more of an issue when the required minimum distribution age was 70 and a half, and you had a little bit more confusion around when you needed to take that. Now that they've just moved it to the year you turn 73 or the year you turn 75, this happens less frequently because the rules for when you need to start taking it are a little bit less. You do see it happen every once in a while if you have someone that doesn't need to take money out of their retirement accounts, and then you see them like just forget to take it out 1 year. They can get penalized on it. But again, this allows for a substantially less penalty off the top and then a pretty generous correction window to get that penalty even lower. So it's kind of nice. Now, some other notable changes here that you're going to want to notice is, and again, there's a lot of more notable changes. Just here are some that we thought were at least kind of interesting. So one of the big things is effective 2024, employers will be able to amend their plans to allow matches to be paid towards student loan debt. So this is something that is kind of interesting because if you have a large student loan balance and you want that matching contribution to go towards it rather than go towards your retirement, that's an option that will be available to you in 2024, which is kind of interesting. And it'll be interesting to see like if that's going to hurt long-term retirement projections or be beneficial for getting rid of the student debt crisis that we have. But that's going to be at least an option available. Also in 2024, there'll be the kind of start of a starter 401k, which is essentially for like a small business owner if they want to start a plan. There are some auto enrollments in there. It has lower contribution limits that kind of match the IRA limits. It's kind of hit or miss if this is useful or not useful compared to just starting a normal 401k plan, but it is at least available. And then in 2023, so this year, essentially employers are able to provide benefits to employees to sign up for their 401k plan. Like an example is paying for a Starbucks coffee if you sign up or increase your 401k plan deferral. So it's essentially allowing employers to incentivize more than just the match for employees to start participating in retirement plans and employer sponsored retirement plans. So it's kind of neat just because one of the big things we see is like a 401k is probably the most common vehicle used to build retirement savings. So having employers be able to really push that and incentivize people to do that is really, really nice. So that is a cool thing. But again, we've done most of the big changes we had. I did not read everything on the slides, so feel free to go back, pause this on the slides. But again, we're going to link the article. It's about a 31-page article that goes very in-depth on a lot of the changes we didn't mention and more depth on the changes that we did mention. But we at least wanted to put this out to you guys so you kind of have an idea of some of the major changes we saw in that Secure Act 2.0. But check out our other videos, and I hope you have a great day.